Hello guys, in this short video I'll be explaining the first part of chapter 25, the analysis of accounts. This is related to what we studied in the past two chapters. We studied the income statement and the balance sheet, which are two types of financial statements. In chapter 25 we are going to study how these data inside the income statement and the balance sheets are being analyzed in order to check the performance of the business and the business's financial strengths. Okay, so who is interested in order to analyze this data on the income statement and the balance sheet? The stakeholders of the business, the owners of the business, the managers, the employees, the suppliers of the business, the banks, and also the governments are interested to analyze the financial statements. So what do you want to know when you are analyzing the financial statements? You may want to ask, are the profits of the business this year are rising or falling? You may be interested to know, do the business have enough cash to pay its short-term debts or no? Do they are able to take loans and repay the loan with its interest rate or no? Do the business have enough profits by the end of the year to reinvest it in the business in the next years or no? So in order to answer these questions, we are going to use ratios. So we have two types of ratios that will help us in order to analyze the business financial statements. First type of ratios is the profitability ratios, and the second is the liquidity ratios. So let's start with studying the profitability ratio. What is the profitability ratios? As its name implies, this is the ratios that is used in order to see how the business is profitable this year. Okay, so do the business was doing enough profits this year or no? This is what you are going to check when you are using the three profitability ratios. We have return on capital employed, we have the gross profit margin ratio, and the net profit margin ratio. So let's start with the return on capital employed. What is the meaning of capital employed? This capital employed is the amount of capital that the business use in order to generate profits. So what is the return on capital employed? This is how much net profits in terms of the capital used to generate the profits. We calculate the capital employed by adding the equity of the shareholders and the non-current liability. Non-current liability, of course, like the long-term loans. Okay, so the higher the ratio of the return on capital employed, it means that the business is doing better or its profitability is good. The second ratio is the gross profit margin, and as we studied in the income statement, we are calculating the gross profit as the difference between the sales revenue and the cost of the goods sold. So gross profit margin is how much is your gross profit in terms of the sales. So if I told you that the gross profit margin this year was 40%, this means that for each $1 of sales you are making, you are generating 40 cents as a gross profit. The same for the net profit margin. Net profit margin from the income statement, we are calculating it as the difference between it's being calculated by deducting the expenses of the business from the gross profit. Okay, so if this ratio is 30%, it means that for each $1 of sales you are making, you are generating 30 cents as a net profit. So in order for you to know how to increase this ratio, if you want to increase the gross profit margin, and as you know that the gross profit margin is the difference between the sales and the cost of the goods sold, so if you want to increase the gross profit, you will either raise the sales by, for example, rising the selling price, or you may check how you are going to decrease the cost of the goods sold. In order to decrease the cost of the goods you are selling, you may try to check for another supplier who is offering you the goods for a lower price. The same for the net profit margin. In order to increase this ratio, you have to check your business expenses. You may think that you have to deduct from the wages of the workers, or you have to check for another location with a lower interest, with a lower rent expense, or you have to also increase the gross profit margin in order to increase the net profit margin. Okay, this is the three ratios, the three profitability ratios, or the three ways we are going to use in order to check how was the business doing this financial year in terms of profits. Next video inshallah we will be discussing the liquidity ratios.